Good morning, everybody, and welcome back to Schwab Coaching. It's our Monday edition of Trader Talk in today's market, and I'm your host, Kevin Horner. I am joining you from what is sure to be a non-white snowy Christmas here in Denver, Colorado. Unfortunately, a lack of snow always kind of tends to put the squash on my enthusiasm, but nonetheless, it is the holiday week. I'm glad you all are here. I'm pleased to be joined today by my friend, Schwab Regional Investment Strategist, Michael Bruskoff. Good morning, Mike. It's great to see you, buddy. How you doing?
Hey, Kevin. Good morning. How are you doing?
Fantastic. We got a shortened holiday week ahead of us. Market full day today, but a half day tomorrow, closing at 1 Eastern. Just a brief reminder for all of you. But I'm looking forward to discussing kind of the end of things, if you will. This is my last show of the year, but I thought today, Mike, we'd look at some longer range charts and see if we can see any support zones we might have found over the last couple of trading sessions. It's been a little bit of a rough go of things the last couple of days.
Yeah, certainly rough go of things over the last couple of days. A lot of movement out there with Jay Powell and friends with interest rates, market trying to find a new foot out there. But I think on a lighter week in the market, I think we can get everything caught up to where we need to be, Kevin.
I think so. And that's what we do here. We talk the charts. We look at some levels with all of you. So hopefully we'll give you guys some areas or zones of interest for a lot of these major indices to keep an eye on. As well, we have our friend Cameron May in chat today. You can say hi to Cam. He's going to keep an eye on the chats in there for us. Of course, answer questions that Mike and I are unable to get to. Please take a moment if you're not already doing so. You can follow Cameron and me on X. Cameron May CS and Kevin Horner CS. We would greatly appreciate that. And of course, if today's conversation is something you value, you get something out of it, hit that thumbs up button for us down below. That certainly helps us out in getting our segment out there to the masses as well, which we would appreciate too. So let's get to some disclosures and then we'll get into the fun stuff with all of you. Please remember that our conversation here is exclusively for your information and your education. We do not make recommendations nor endorsements of any particular trading strategy or approach to the market. We do talk technical analysis quite a bit, though, covering concepts and strategies traders may choose to employ. Please continue to think of technical analysis as a complementary viewpoint to your fundamental research. What we mean by that is we believe technicals are a part of that puzzle. They can help you make your decisions, but you don't want to base your decisions exclusively off of what you see in the charts. All right, so as an agenda goes, we start broadly here in this segment. We look at the major indices first, hitting up the S&P 500, the NASDAQ 100, the Russell 2000, perhaps the semiconductor industry, moving through some of the sectors as well. So we kind of do that top-down approach, that filtered approach, if you will, looking large, down a little bit, smaller, all the way down to individual equities. So we should have a few stocks in the news today as well. We'll try to get to as much as we can for you all today. With that, Mike, let's start us off as we always do with the S&P 500. I'm on the daily chart here, Mike, and I've got a rising wedge built in, something that was in place for much of the rally from August 5th off that very weak open all the way till, well, really middle of last week when things kind of got a little uncomfortable for us.
Yeah, as you look at what happened last week, and technical air parentheses, some technical damage that was done to the market. Maybe we'll find some support levels at the area that we are at right now. I'm looking where our candle is that we just opened at right now, trying to push right above that 50-day moving average, which I believe, if I remember correctly, Kevin, the Horner rule of trying to stay above that 50-day. I'll say from our point of view, and you and I have been friends for a long time, that's a critical point to the way you look at things in the market. And I'm not going to disagree with you. I think trying to get its head back above the 50-day moving average, I'll just say as a short term, we've been in a bull market all year, but as things look like the wheels, maybe air parentheses, starting to fall off a little bit, it'd be nice to hold on to the 50-day moving average right now.
Yeah, you're absolutely right. Sure would. That candle opening above the 50-day, giving us maybe a little bit of an optimistic feeling here. But you touched on the so-called Horner rule. If you were looking at the 50-day moving average as support, Well, we certainly closed below it on Wednesday, closed below it on Thursday, rallied to challenge it on Friday, traded well above it, Mike, and then yet our close on Friday came in at 59.30 and the 50-day is 59.27. So technically, yes, we were day 3 back up above the 50-day, but I could understand nonetheless some consternation about, do we hold the 50-day here now? It really leaves us with very limited room for error if you're going to base your decisions off such things as, did we hold the moving average for a number of days consecutively? It definitely leaves us a little precarious here, doesn't it?
It leaves us precarious on, to be honest, a short volume week. So now we can get a move, what I'll say, to the negative side. If you're a bear of the market, or if you're a bull of the market, it would be to the negative side. That maybe we can't appear to hold that 50-day on. I mean, tomorrow the market closes at East Coast closes at 1:00, right? So we're going to get a light volume Christmas Eve day. Obviously, we kind of expect that we're going to volume, but even then, you can start to see some lighter volume. So a move up or down could be over exaggerated to either side. So from our point of view, let's hope that the exaggerated move stays to the north side of that 50-day if you want to maintain that bullish outlook going into year's end. But I do think that support line of the wedge that you drew was probably a little bit bigger of an issue. And I know you wanted to expand that chart out. If you can kind of show the middle of the summer, where we were kind of, as we look at the S&P, kind of, we were having some areas where we were having a touch of a hard time getting above. And you can see how we've been able to kind of use that area where we came back down to this 50, I'll call it 50 level, Kevin. I'll call it 5,900, that we used it as support. And I think that that's a good sign for the market, right? It was a bad week last week, and I don't even know that it was a bad week. Jay Powell said he's not going to put interest rates back down to 0. They gave him a Fed funds plot, not 0. I think that's right. We were expecting, the market was expecting 4 cuts next year, 2025. The dot plot only showed 2, and the market had a little bit of a heart attack. And I don't know if it was justified or not. Obviously, that's what makes the market go around. But I was a little surprised at how much the market kind of sold off on that, on a little bit of news that, yes, Kevin, the economy's strong, employment is strong, people are out there spending money. Yes, we do want to get inflation down, but those are still kind of signs of a little bit of a strong economy. So it was a little confusing to me, Kevin, but love to hear your thoughts.
Well, I feel like the same, to be honest, a little bit confusing, but at the same time, what are we talking about? We've given back a whole 160 points from our peak. It's really hard to be terribly upset about such a minimal pullback. I do agree the market was hopeful that we were going to see more cuts in 2025 than the stated perhaps 2 cuts we could get in 2025. The market, of course, wants easy policy. It wants cheap money. It wants to be encouraged to deploy more money to risk assets. That's the equity market, everybody. And so with rates not necessarily getting tamped down as much as the market was positioned for, it makes sense that we would get a little bit of a sell-off here. And I say sell-off, ultimately, it could just be considered profit-taking because, as Mike pointed out, the level to which we fell was our same support that we retreated to here post-election. So we had the big election gap to the upside, and that's what we tested. Did we fall through it with our low on Friday of last week? Absolutely. But it is notable that we fell through that level, and that brought buyers in. Okay? So as always, time frame matters here. And on a daily chart, consternation is absolutely understandable, and defensive action for those of you protecting profits into the final trading week of the year, that makes a lot of good sense. Remember, individually, we're all very different. Follow your own trading rules, what you've set for yourself, regardless of what you might see in terms of our chart viewpoint here. If your time frame is one of longer term, well, then you might have a slightly more comfortable viewpoint, and let's show why. If I pull this back to the weekly chart, Mike, I'm going to eliminate all my drawings in here, everybody. Look at where we are. Where did that low from Friday of last week hit pretty darn close to that green 20-week simple moving average. And as we have talked on this show a number of times, we have been above that green simple moving average for all but 1 week in the last 13 months, everybody. So this is a well-established level for a longer range investor to look at and say, we're still in the uptrend here. In fact, Mike, I think a lot of traders would tell you we'd have to get under 5,600 and maybe that 40-week moving average, Mike, before we find a place where we're no longer in trend the way we have been for the last 13 months. Your thoughts on that, Mike?
Kevin, hard to disagree, right? Hard to disagree with 13 months of strong movement in the market to the upside. As you pointed out, 1 week where we barely touched what would have been the 200-day moving average on that spot. So I think that's well taken. And I'll say if the Bears want to have, a plus sign, maybe the market has to work off a little bit of an overbought condition. Maybe it has to work off those expectations of 4 rate cuts next year. And maybe as we're getting a little closer into focus that they're only going to get 2. Doesn't mean things are bad. Just maybe things were over a little overbought at the end of the year, right? That's all.
Yeah, and again, it's understandable because we had conversation around the opportunity for more cuts. In fact, I was just looking at the CME Fed tool expectation for January meeting suggests a pause in the cutting cycle for the coming report or for the decision on January 29th. If you go out to March, that's a little more like 45-55 split of cut versus pause. And so there's still plenty of, if you will, health to the overall U.S. economy, because I think that's what the report from Jerome Powell was kind of pointing out, Mike, is that the health of the jobs market in particular is, as much as we want to continue to cut rates, we're noting that the recent rate cuts have had some impact on the job cycle, if you will, but we're back to a spot where there's really no alternative for those of us that monitor the market on a day-to-day basis. We really have to pay attention to this stuff because these are the headlines, Mike, that are going to drive market movement in the shorter term here. So we've got plenty to keep our eyes on as we close out the year. Let's shift quickly from the S&P 500 over to the big caps, the NASDAQ 100, the biggest in the technology side of things. We'll go back to my daily real quick. And Mike, I was talking about how quickly sometimes we can move through the upper trend line of a channel like this and then just completely get beaten back. Mike, were you shocked at all by the action we got early last week that took you through the trend line to the upside, implying bulls were in charge, and then real quickly 2 days later getting beaten back all the way to the same trend line, the uptrend that's been working since August 5th?
I think that's what the frustrating part of the market is, Kevin, right? Like you hit it right on the head right there. Like Monday, oh my God, we're going to be cutting rates and we'll probably be negative rates by the end of the year, right? Now, and again, it's tongue in cheek, but that's what the market was expecting. And I think the market just got a hard reality that, I'll say Jay Powell's still in charge, that, hey, now we're not cutting interest rates as quickly. We didn't say we were done. No, you didn't hear Jay Powell say he was done. And the market's interpreting, hey, the rate cycle is over. No, they just had 2 cuts versus the 4 that the market was interpreting. So I think those are, fine points of language. But I think, yeah, did it seem a little shocking at the swift move it did? Did it seem a little shocking that we're now back down on the NASDAQ 100 back to the 50-day moving average, hopefully able to use that as support? Yeah, maybe. Even if you look at today's price action, we jumped over the 20-day and now we've pulled back. So now is the 20-day resistance on there? Right? Now again, we're open 15 right now. But I think one of the bigger things is, as you looked at your RSI, we were trying to get to, overbought last week. We barely got there. On some of the, on the S&P 500, we broke down below the RSI where it came into oversold. It came into oversold on the RSI. But now we look at the NASDAQ, it didn't get to oversold. What's it going to take, Kevin, to get that, to get to a spot to be oversold?
It looks to me, Mike, like it's going to require a lower low in price, right? Because these lows are still higher lows along the way. Yeah, my trend line may have broken for all of a day, but we've held the 50-day. There's perhaps a zone of support right there. I mean, it's also kind of coincident with the prior peak right there. Let's make it a line instead. So right through this zone, perhaps, this looks like horizontal support approximation. And then you called out, I like what you called out here because you're right. We did get into overbought territory. You could say that the high we made was at least validated by RSI, and further, that our retreat came to true oversold. I say true. Remember what the RSI means, everybody. We're talking about the momentum of the current trend. And when we look at RSI, in a strong uptrend, it's often stated, Mike, that you can get retreats to the approximate 50 level in the RSI, and that in the midst of a strong uptrend could be considered overbought conditions. It's actually, Mike, where we got a bounce. So does that maybe imply that we remain in the uptrend here? I mean, price action dictates that we remain in the uptrend, right?
Kevin, I think, which comes first, the chicken or the egg, right? So I think you're saying the same exact thing. Yeah, listen, I agree with you. Right now, we're still in this uptrend. It was a little bit of a correction from the uptrend, maybe took a little steam off of it, but I'm not making it. You break your white support line that you have on there on the NASDAQ.
All right, Mike, it sounds like we got a little bit of struggle there with your microphone, but not to worry. I think I heard you validating my viewpoint here, which I will take, because the one thing I've learned is that when you hear the answer you're looking for, you take it and you move on. So, Mike, I'm going to shift us here, everybody, briefly off of the NASDAQ daily. We're going to do the same thing we were looking at with the S&P. So we're going to kick us over to the weekly chart here real quick and notice once more that line I just drew in looks to be appropriate from a horizontal standpoint. Again, look at the difference between us, where our current level is, and our green 20-week moving average. And maybe on the NDX, everybody, how the 40-week moving average here on the NASDAQ 100 looks to be a little bit more appropriate. And what I find nice about this one, if nothing else, everybody, is that the 40-week, we actually broke this way back in January of 2023. So the overall broad market strength has been much stronger in the NDX, even though we've undergone bigger swings. And I think it's a healthy reminder that allocation of the assets, the breakup of the funds within a given group, like the NASDAQ 100 versus the S&P 500, you've had a similar trend working all along the way. And you have not, outside of 1 week, been provided any real reason for exit. In fact, the fact is we closed above that 40-week, that August 5th low. That was as I recall, the end of the so-called carry trade. And that was the bottom to the NASDAQ. And now what we've seen is a push higher. We've had the Magnificent Seven leading the charge. And further, one of the things that I just picked up this morning from monitoring my friend Kevin Gordon on X is that now the top 10 holders of that S&P 500 make up nearly 40% of the market cap of the S&P 500. So we've seen a continuation of these so-called the biggest stocks, not that necessarily just the Mag 7, but to incorporate the top 10 of that S&P 500 has been very, very overall very, very strong, right? So nonetheless, you've had a group here that continues to provide some semblance of leadership with the NASDAQ 100 and a couple of different zones of potential support regardless of your time frame, everybody. But as I often say, the time frame is important for each of us individually, but what matters to us is price levels, of course. And so make sure you've defined the levels where you're ready to take action, right? Even if you're feeling like you're battling against this decision to stay invested versus take a little bit of profit or take a little bit of your investment dollar off the table as you head towards next year, whatever is going to give you the greatest amount of comfort to turn the corner and turn the calendar into next year, then do that. Do what makes you feel comfortable always, every step of the way. I think that's a good reminder for us all. All right, I'm going to push us back into the Russell 2000. Let's see if I've got Mike's voice fixed up here. Mike, we cratered through the 50-day moving average. My series of lovely stair steps along the way had worked out so beautifully for so long, and then inevitably we tripped heading down the stairs, it looks like. Mike, what do you see here?
Kevin, hopefully you can hear me. Sorry about the technology issues today. But what I would say, if you can hear me, and I think you can, listen, same sentence that we were just talking about the market's expectations for interest rate cuts. And as soon as they get a little bit of a cold wind, all these small cap Russell 2000 stocks, they sell off in 2 seconds because, again, lowered rate expectation cuts. I get it how it's beneficial. Lower rates are beneficial to the small cap stocks. I get it. You and I have talked about these, the Russells for years, and they finally get up to a level where they look like they're breaking out. And now they broke back into the trading range that they were in for almost over a year and a half now, all of a sudden. So it does kind of, it's frustrating. That's what I would say. The Russell 2000 it's frustrating that it can't catch its feet to just kind of build some momentum. And you can see, hopefully now, I mean, it's hard to believe that we were so far above the 200-day now that the 200-day is coming right back into play. Hopefully the 200 will act as support, because I do think this is probably a little overdone on the small caps.
I tend to agree, but as a rate-sensitive group, you can understand the reasoning here. One thing that we want to point out as it relates to the RSI, everybody, notice where my line was, that 45 level approximately. That's about the last-ditch effort from an RSI standpoint to validate that we can still remain in our uptrend. The fact that we got it down to the 30 level tells us that we may very well, of course, price action tells us we broke the uptrend line, but may very well be looking at no longer an uptrend. So perhaps we have devolved into more of a neutral to sideways price action from here. We'll see if that plays out. I think for a lot of traders, as Mike suggested, we're going to have to monitor that 200-day moving average around 2155 up to 2160 to get some clarity on this. If we did this with the weekly and take a peek at where we've been, it's been a little bit more messy as it relates to the RUT here. But again, that 40-week moving average, we've been above it since December of last year here. So really, maybe it's the 40-week. And again, that is pretty darn coincident with the 200-day. So that gives us something to monitor on small caps. All right. I saw a couple of you pointing out today, we've seen the semiconductors doing something they haven't done a whole lot of late. That is move higher. Let's take a look at how the semis appear. We fell out of my triangle once more, everybody. This is a real difficult chart to get a handle on, isn't it? We had that breakout to try and validate a new move, and we got through the downtrend line for all of one day. We did not get true validation with multiple closes there, Mike. Are you as dubious about the semiconductors opportunities moving forward here as I am?
I'm not, when you look at it from a chart perspective, it does look dubious, right? So I'm going to go by that because that's kind of the topic that we're looking at. Yeah, I don't like that. Even if I drew you had a upward support line, that white line that we're, I'll say, barely holding on to right now, that we're up a little bit above there. Yep. But I look at that more as a horizontal support. Right, go down a little bit right there, about 49, 48.50, somewhere around there. That's a support line right there. And yes, it does look dubious. Everything that you said, I'm not even going to disagree with. The fact that we're holding that support area right there might bode a little bit better for them to push right back out. Because you could see how, the 200, if you can kind of look in there, the 200 and the 50-day are converging on each other. I will say, Kevin, and I know you know this, I wouldn't really want to see, if we broke down below that support level, it would bring the 50-day below the 200, which would pretty much set off a whole entire new trend for the stocks. So it's hanging on. I think you said precarious. I'll use life support. Yep. Same sentence, Kevin. Same sentence.
You're absolutely right. I mean, my goodness, all three of those moving averages converging on one another. Your 20-day, your 50-day, your 200, all coming together right here tells us that we've really gone nowhere over the last 20 days or the 50 days or the 200 days, because essentially those levels are all right on top of each other. That tells us that three traders in three different windows of time are all monitoring this 5,050 level, and it could be dictating for us the next move, right? Do we break out to the upside, telling us that bulls are back in charge, or does this reflect as a potential rejection zone, in which case we would suggest perhaps the bears are more inclined to be in charge here and we need to sell down a little further? Yeah, we have the potential for that 50-day to cross the 200 to the downside. We haven't really seen that in quite a while. In fact, Mike, I'm on a 2-year look back now. Even when we broke the 200-day way back in November of 23, we didn't have the 50 crossing the 200. So we've been all the way back here. I mean, the buy signal on the so-called the golden cross was way back in January of 23. And you may very well in the next 3 to 5, 10 sessions see the inverse of that, the death cross, as it's called, the 50-day crossing the 200 to the downside. But Mike, I can't help but point out, if and when that were to occur, that is not a short-term bearish situation necessarily. It's something that plays out over much longer windows of time, typically. Has that been your experience as well?
Kevin, when we have a trend such as we've had in the stocks as an uptrend, and it hasn't been in what we would call a trading range, bouncing around above and below, I think the signal, couldn't even get it out, Kevin. The signal is more valid when we break an uptrend by crossing down below that 200. So yeah, I would agree with you that, quote unquote, if we break down below that 200-day, 50 crossing negatively below, that would probably be entering more of a bearish market for the stocks, because we've been in a long-term uptrend, as you just said, since January of 23. So it would almost be a 2-year uptrend that we would be breaking at that point.
Yeah.
So
that seems
well taken.
Yeah, that seems notable, doesn't it? And you can see here, yeah, we are just, look at all the price action just smashed between my lines as we continue just to stay within the triangle. But we are, as some of you pointed out, yeah, we are reaching the apex, BJ. You're absolutely right. You would expect to see a break one way or the other in the near run. I'm noting here the RSI has even gone sideways. So, yeah, there's just a whole lot of consolidation. But the last point I'll make is when I look, even though we have the opportunity, we could break this to the upside, Mike, there's still a fair bit of resistance up here where we have retreated when we've gotten into this approximate level. So between about 53 and 5,400 on the semis, on the indice itself, just watch this zone. Really, even if we broke the apex of the triangle to the upside, if we got rejected at resistance once more in that 53 to 5,400, that still could be negative over the longer range. Obviously, if we were to add 200 to 300 SOX points to the upside, that's going to feel good in the short run, but that doesn't mean a shift to the longer run trend nonetheless. We got to bear that in mind. So as always, as I like to say, know the time frame, know the levels that are important for your time frame. That's the way we want to kind of define our approach, at least. And by defining our approach, what I mean is defining our tolerance for risk. Where will we as individual traders make a decision, right? In the short run, you might have a level that you like. Maybe it's 5,100, for example, a level above which you'd say, all right, that's a nice round figure. And above there, I'm going to feel bullish. But the point being, know a level and how you want to act when that level gets achieved, whether it's to the upside or to the downside, right? Okay. Mike, let's take a look at some of these individual sectors in our market that have been kind of struggling here. Energy has just been absolutely beaten down. We broke a very long range trend line, Mike, And I know that traders are wondering, are we at least going to get some kind of snapback move here in energy? Right now, we're just holding on by the skin of our teeth, holding to the lows we made last week, Mike. What are you watching as it relates to energy here?
Yeah, Kevin, a little, when I look at this particular group of stocks, a little bewildering, the sell-off. I'll be honest. Of all the sell-offs that we've got out there, this one's a little more bewildering. Obviously, it has to do with supply and demand more than anything else, right? Right? And that's really been the catch-all phrase. But I appreciate you drawing that support line right there, because I think that's an important area. Again, just as we're noting, well below the 200-day. The purple line looks like it's going to negatively cross another negative cross. We were just talking about that on the stocks, talking about it the same thing here on the energy sector. But I like that we've held that support level. You've got that going back a few months back there, almost towards the year low, towards the beginning of the year where we had those lows. But I'm a little concerned that if you look at your RSI, we're breaking down. Things can stay oversold. We can stay in that oversold area for a little while. So while it doesn't look good. I'm going to be honest. It doesn't look good. It's been pretty steep sell-off. This one I'd probably stay away from it for a few seconds, just till I could see some kind of support. We're hanging here at support, but I'll say it's a precarious level.
It is. And you're right. A lot of traders, Mike, when they see a sell-off like this, and it's big, if we define the level just from the peak here, my goodness, a month ago to where we are today, you're looking at a nearly 15% retreat. And that has been 15% in a month on an entire sector is a substantial bit of selling. Now, when I look at this, I'm sure I'm not alone. There's a lot of traders who are saying, yeah, like you did, Mike, let's let the dust settle, and then I'll consider whether I want to take a position here. Positioning at this point, I think bulls would say, yeah, you've got risk versus reward on your side, but you've got just as many risks associated with potential downside as you do upside. So it'd be a counter move to go long here, counter to the recent trend at least, right? But maybe a bounce gives you the trend line we broke. That could be the extent of any bounce, everybody. Notice the RSI got well below the 30 level. I mean, we didn't just get into oversold, Mike. We got into extreme oversold. And you know what? I can't help but remind us, Mike, that when we get oversold like this, traders want to believe. We're like you're like David Duchovny in the X-Files. You want to believe that this is your chance, and yet you can't necessarily just say, "Oh, because it's oversold, it needs a bounce, and it's going to happen in my time frame." That's just not the way the market works most often, is it, Mike?
No, it's not, Kevin. And what was a little more concerning is towards the latter end of last week, those two gigantic red candles, there was a heavier volume coming in. Not tremendous, but heavier than been over the last couple of weeks. And that does kind of make me concerned. Now, I don't know your candle today. I'm not seeing that on my chart. It seems like a little high volume today on the candle that's being made today, unless I'm reading something. Oh, okay. No. Yeah, your volume there. My eyesight's that bad, Kevin. So yeah, I'm happy that that's not the volume. But that was a nice volume on Friday. That was triple witching. Get some volume. Maybe that puts in that support that we're grasping for right now. But yeah, I think we can find better looking sectors out there right now. But I don't know that I would be jumping into this one in particular, because you're at a nice support level, but we break the support level. The next level is pretty far down. I'd be cautious. Sector.
I think that's a great way to remind ourselves is that what would be the next level? Would it be the lows we set back here? And if that was another 30 points below us, that would be about 5% further. And you know what? That might be comfortable for some who are looking to deploy money there. Maybe you're light on exposure into energy in your long-term portfolio when a sell down like this provides ample opportunity to get some money to a group that's maybe a little overdone. I could understand that in a longer range portfolio, of course, but nonetheless, not a great look here for the last month. Now, we have a couple of groups that have looked fantastic for the last month plus. You've got discretionary, which has now retreated on that little bit of profit taking. Extremely strong, Mike. Our RSI pushing well over 80 here. Our on balance volume validating everything. A legitimate breakout through discretionaries looking strong. We've also noted something similar in technology, although not nearly as strong collectively. It seems like discretionary, I mean, the health of the U.S. consumer is strong, even if we're not using cash, we're using debt to do it, Mike.
Yeah, and I think the consumer being strong is what's giving the market a little bit of a heart attack on the other side there, Kevin, right?
Absolutely.
You know, how can you have both? How can you have consumer discretionary strong, interest rates looking like they were coming down and now maybe potentially flattening? Is that going to eat into the consumer as we move through the first quarter of next year? These higher for longer rates. I'm not thinking that that's going to be a big major factor for the market, but the rate of the sell-off that we had last week when they heard interest rates weren't going to come down seems like the market's putting a bigger bearing on that factor.
Yeah, I think so. The level we're at is a pretty intriguing one from the trend standpoint, everybody, because again, that 20-day has been held for quite a while. You're looking at 2 months full above the 20-day, which is getting a little long in the tooth, isn't it, Mike? I mean, we tend to see these trends go. We can see them for 4 to 6 weeks kind of commonly. Now we're in an 8-week window of maintaining the 20-day. It's nothing but an anecdotal comment, Mike, but a larger group like a discretionary sector, for example, might be getting a little tired in its existing trend. Do you ever assign time to your trends, or do you just default to price action and the trends themselves and not really worry about your time frame associated with them?
I think it's a little bit of both, Kevin. I mean, sometimes I certainly want to look at how long we've been in this trend and how long can it continue, right? Those are things that you certainly would want to be aware of. But I also think, reversion to mean a little bit happens as well, right? So as we start to pull back in, it doesn't mean the consumer's that I'm not in that camp, but I think when you look at the consumer discretionary stocks, the consumer has been very strong. And it was fueled by, a late summer, early fall reduction in rates for the consumer. Now that the reality is that rates might not go much lower, let's see how that hangs on. Let's see what that looks like.
Yeah, it could prove to be problematic for the discretionary space if the consumer is already maxed out on debt levels, for example, and there's been some discussion that we have pushed debt levels a little higher than maybe we've seen in the past. So that seems something to keep an eye on as well. You know what? I thought for sure as we got towards the end of the year, we'd start to see rotation into some of our defensives. Our staples have broken down further. I thought we were going to see us hold up here. That did not maintain. So we might be through support, may have to see the 200-day on staples. The real skunk has been healthcare, Mike. I just can't get away from the fact that the market has really devalued healthcare since the completion of the election process. And there's a lot of concern about healthcare in the shorter term here. And that's why I think you've seen a lot of selling in this space, Mike. It's an area that is really in a pretty ugly move here. Now, we fell through what I had banded as longer range support. And we fell through it last week, Mike. And you can see how on the weekly chart, boy, we are below all three of the weekly major moving averages, putting us now below the 100-week. This is a bit of a problem for this space, potentially, isn't it?
I think this is more based on, and I agree with you, your analysis of the chart. I also think maybe, and again, I know we're not politics, but I think maybe this is not a sector that's going to be viewed favorably in this administration. I'll leave it at that. I don't know that healthcare is a sector that's really going to benefit under some of the new potential policies that are coming out. And we've heard rumors of that over the last couple of months, but I think if you look at the sell-off really since over the last couple of weeks, it's kind of getting to maybe that might be the messaging. But if you can do what is the sell-off percentage-wise that we've had in those last 20 sessions? I mean, that's quite a move downward.
Well, if we're talking from the peak, 1836 to the low we just made last week, for example. If I can get that to snap itself. There we go. That line says 14%. Again, another big sell, almost as bad as the energy space.
Right. So this one makes a little more sense. Maybe the energy one is a little more confusing to me, but I do kind of understand this. I think I look at that zone, that support resistance zone that you drew with that gray line.
Yeah,
it doesn't make you happy. You had strong volume on Friday coming off on that as they were selling into it. So yeah, this is not, as we're setting up and looking for the Santa Claus rally, maybe some of these things bounce off of some of these lows, and maybe we get that bounce a little bit.
Sure.
But it's not setting up that, hey, we're breaking out on the market to all-time highs right now. Doesn't seem like we're heading for that.
I think that's the reminder. That's the thing we want to bring to the table here. And Mike, as we wrap up in our final few moments here, I wanted to bring to the table one chart that we were talking about pre-show. It's one that our friend Rachel Deshelle, who's also on the segment here once a month, just like you, another regional investment strategist for the firm. She brought this chart to us last month, and we looked at it because we were doing so well. We were talking about the overall health of breadth in the market, and we were feeling really good about it. Unfortunately, Mike, since Rachel brought us that chart, this chart we're now looking at, things have deteriorated, unfortunately. Let's talk quickly around this. The first level up here, everybody, is the S&P 500 stocks above their 200-day moving average. We are now, Mike, at the low of the year. The same is true about the S&P stocks above their 50-day moving average, the low of the year. And look at the new highs, the low of the year in the NYSE, and then the NYSE new lows last week, making highs again. So, Mike, breadth has surely seemed to deteriorate here, hasn't it?
And very quickly. Very quickly. Like, when I was looking at this chart, and I thought it was a great chart that Rachel had brought on, and I was thinking about it, I was like, how have we changed the tone of the market so quickly, right? And, the speed, and I think that goes out there to all of our investors, all of our traders that are out there watching, it's always a good reminder to have a strategy in place, whether you're buy and hold, whether you're short-term trading, and I'll focus on the short-term guy right now. What's your risk management procedure? How do you plan on getting out of these stocks? Kevin, I'm not looking to keep buying more as they keep going down. I got to have a disciplined approach to the market. And right now, as disciplined as I want to be, this particular chart is telling me that the breadth of the market is changing very quickly. And we had been wanting the breadth of the market to participate to the upside. Well, now it's participating to the downside. Am I blind to it, Kevin? Am I paying attention? Do I have a risk management plan in place? I hope that our listeners do, because some of those things really change pretty quickly, Kevin.
Yep. I think that's the reminder here. Mike, we're not throwing these charts up with a means of suggesting that A is going to occur now because of what we're seeing here, or that B is going to occur because of what we're seeing here. What we are encouraging is to utilize all of this information to formulate a plan so that you know how to handle things when A happens versus when B happens. Remember, there's A or B or C or D are always going to happen, right? And it's incumbent on us as traders to know how we will act based on that. What steps will I take that are going to make me feel more confident and comfortable with my portfolio if things break down? What am I going to do if things move to the upside? Am I going to deploy more money? Am I going to sit on my hands? Am I going to stay true to my intermediate term viewpoint, and et cetera? All of these are questions that I hope you are asking of yourselves as you're basing your decisions and building and formulating your plan for the way you're going to approach your trading here. I just don't think that there's a better way to kind of wrap things up, to be perfectly honest, Mike. I think as traders, we have to know how we want to act. That's what's going to give us the confidence to stay long the market as long as you possibly can, or to start generating cash as you need to as you get towards the end of the year here. Mike, it's been a really, really good 2024 for us here in the market broadly, and certainly for us here on the Schwab Network and the Schwab channel, rather the coaching channel, I should say, excuse me. But I'm glad to have you, Mike. I'm really glad I got you back in my bullpen of regional investment strategists to join me here on Monday. So thank you so much for your sharing your thoughts, sharing your insights and ideas, and for being a guest host on my show. I appreciate it.
Kevin, thank you for having me. Wishing you and your family a happy holidays. And for the holidays for me, hopefully I'll get a better connection next month and we'll have a better connectivity. So I apologize about that, Kevin.
Appreciate it, Mike. Don't worry. We'll get you fixed up, I promise. And to all of you, again, a really happy 2024 year end. I hope your holiday season is fantastic. Again, I am off after this, so I will be reconvening with all of you in 2025. Check out the schwab.com/coaching calendar, which is, again, that link right beneath the window here. We look forward to reconnecting with you next year. But again, have a wonderful year end, everybody. Thank you so much for joining me all year long. It's been a true pleasure on my end of things. Big thanks to my friend Cameron May in the chat. Follow Cam and me on X and hit that thumbs up button down below for us. We appreciate all you do for us as coaches, everyone. Have a great day, and I look forward to seeing you all again real soon.